Normally, we need to record an asset in our books only if we legally own the asset. IFRS 16 is an exception to this general principle. This accounting standard revolutionizes lease accounting by bringing most leases onto the balance sheet. With IFRS 16, lessees need to recognize assets and liabilities for all but short-term leases. Now, let's dive into the world of IFRS 16. Let's first understand the meanings of some basic terms used in IFRS 16. First, lease. It is a contract, or part of contract, that conveys the right to use an asset for a period of time in exchange for consideration. Second, lessor. The entity that provides the right to use the asset. He is legal owner of the property. Third, lessee. The entity that obtains the right to use an asset. And finally, lease term. This is the length of the lease period. Note carefully that, if the contract gives an option to extend the lease contract, then the lease term includes that optional period too, if it is reasonably certain to be exercised. Now, let's see. If there is a lease contract, how accounting is done, in the books of lessee. First, let's see how to record initially. That's at the start of the lease. Right of use account is debited. And lease liability is credited. Now, what is the amount of lease liability? This is the present value of lease payments, both variable and fixed, plus residual value guaranteed by the lessee, plus exercise price of a purchase option, plus termination penalties that have not been paid. Note carefully that any advance payment or down payment made is not included in lease liability. Now, what discount rate to be used for finding the present value? It is the interest rate implicit in the lease, or incremental borrowing rate of the lessee. What is the amount of right-of-use asset? It is the total of lease liability amount, plus payments made at or commencement of lease, plus any direct costs incurred by the lessee, plus present value of future dismantling costs. Now, what entries to be made at the end of each year? 3 entries to be made. First, entry for depreciation. Depreciation expense is debited, and ROU asset is credited. Depreciation amount is calculated by taking a period, shorter, of useful life, and lease term. Second, entry for lease payment to the lessor. Lease liability account is debited and banks or cash account is credited. And, finally, entry for notional interest. Interest expense debited, and lease liability account is credited. Notional interest is calculated at interest rate implicit in the lease on the opening lease liability amount. This interest amount goes to statement of profit or loss as an interest expense. If lease payments change due to usage or inflation, then ROU asset and lease liability need to be adjusted for the change. While preparing the statement of financial position, lease liability is to be split into non-current liability and current liability. For this, we need to prepare a lease liability table at the year end. You can prepare the table in this style. With the opening balance, we need to add the notional interest, and then lease payment is subtracted. You will be getting closing balance of lease liability. This amount is to be split into non-current liability and current liability. For that, you need to extend this table for 1 more year. So, closing balance becomes opening balance in the next year. The closing balance figure in the second year will be the NCL for the first year, and the balancing figure of lease liability in the year will be the current liability. If the entity enters into a lease partway through the year, then depreciation and interest will need to be time apportioned. IFRS 16 offers 2 optional exemptions from recognition of right-of-use assets and lease liabilities. First, if the lease is short-term, that is, less than 12 months. Second, if lease is of low value, such as personal computers or small items of office furniture or telephones. Take 20 seconds to go through the question. Initial lease term is for 2 years. But there is also an option to extend the lease term for a further year, which is reasonably certain to exercise. So, the lease term for accounting purposes to be taken as 3 years. Let us first calculate the amount of lease liability. This is the present value of all lease payments discounted at the interest rate implicit in the lease. So, we get $51,542. This is the initial lease liability amount. Now, what entries to be made on the 1st of January, 2021? ROU asset account is debited, and lease liability account is credited. Then for the direct costs incurred by the lessee, ROU asset account is debited, and cash account is credited with $5,000. Now, the total ROU asset will become $56,542. Now, what entries to be made at the end of the year? 3 entries are required. First, depreciation entry. We have to depreciate the ROU asset over the shorter of useful life and lease term. Useful life is for 5 years and lease term is for 3 years. So, we have to depreciate the asset over 3 years. Depreciation amount is $56,542 divided by 3, that is $18,847. Second, entry for lease payment. Lease liability account is debited, and bank account is credited with $20,000. And, lastly, the entry for notional interest. Interest expense is debited, and lease liability is credited. The amount of interest is calculated on the opening balance of lease liability amount at interest rate implicit in the lease. This interest amount will appear in the statement of profit or loss as an expense. Now, how these entries will appear in financial statements at the end of the year. First, in the statement of profit or loss, depreciation expense and interest expense will appear as expenses. Then, in the statement of financial position at the 31st of December, 2021, ROU asset will appear as an NCA at carrying value, that is, cost less accumulated depreciation, $37,695. Then, lease liability is be split into NCL and CL. For that, we have to prepare a lease liability table. So, $18,518 is non-current liability and the balance $17,147 is current liability.